Yo, what's up, guys? So, welcome back to the stream. This episode, going to work on my portfolio management project, or I guess assignment, and involves the idea of factor investing and also constructing efficient portfolios. Let me try to find the instructions. I'll do this in the other screen right now. Okay, so let me just set everything up here right now, and then there we go. Alright, 402. Let's see the assignments. Download. Alright. Let's bring this in over here, and let's bring this in over here. Okay, so let's see. OBS, let's see how that's doing. Okay, my screen froze again, so I'm going to delete this, and then I'll create a new screen capture. Alright, hide OBS from capture, reformat. Okay, and then now just move this back to bottom. Alright, I think the setup's pretty good. Alright. Okay, so the questions that I still have yet to answer, which is most of them, but they kind of revolve around the Fama-French factors that we learned about in class. I think there are maybe two of them we learned about so far. One of them is the HML, high minus low book to market ratios. Book to markets is kind of a measure of a company's assets and their equity compared to the market valuation of that equity. And it's kind of a proxy to explain companies that are more value oriented, in the sense that they have high book to market ratios, versus companies that are growth oriented with low book to market ratios. So what I'm going to do then is I am going to import all this data into data frame. It's probably the best. Copy relative path. pd.data frame. Okay. So if we do data frame, we'll call this Fama FF DF, Fama French DF, and then we'll pass in display FFDF. Alright, and then we'll preview this document, see what it looks like, see what the data looks like. Okay, Porto preview. Damn, there's like a lag between what I type in and what actually shows up on my second monitor here. Oh shoot. Okay. Yeah, this shouldn't be read. It should be read CSV. Here we go. I'm gonna change this. Oops, just disappeared. No. The second monitor is failing me right now. Okay, I'll let it slide. I'm just gonna read through. So, how much of the average return reflects the systemic risk of the strategy? How much of this return reflects performance beyond its benchmark predicted by the CAPM? Does the HML portfolio do better in good or bad times in the market? So that maybe a strategy for finding that out is we could plot the monthly market risk premiums against the returns of HML. Okay, what percentage of variability in the HML returns is explained by market-wide movements? So when we try to kind of explain the variability of some type of random variable, maybe we can kind of we can create a predictive model or estimative model and maybe compute the R-squared. So we could create a regression between the could we create a regression with betas as the independent variable, so the market beta, versus the returns as the dependent variable? Just a thought, not entirely sure. Okay. Read CSV. Oops. Okay, I'm gonna bring this over to this side because it's kind of annoying having to man, what is going on there? Okay. Okay, so we have a few columns here. I think what we might want to do is convert the month column into, let's try to convert into a date time, and let's convert that also to the index of our data frame. I think I actually have some code for that in the earlier section of this project, so I might just be able to copy and paste that.
Ooh, there he is.
Okay, so I think then, let's see. So index column, and then we could just set that to 0. Replace. Okay, so we have the data as the index now.
Putting in PHP.
Okay, so
Have you like read how PHP plays? Yeah, okay, because you know how PHP
divide them by 100. All right. So there's also another case where the returns are. So these are scaled by 100, so you just divide them by 100 to get the final percentage returns.
So like how some names,
Scaled
some of
is
the
equal
built-in
to.
names will be separated by underscores, some of the built-in names will be separated by camel case, some will be a mix of camel case and underscore.
FF divided by 100.
And then you could have probably one dude for the longest time,
Scale.
and he would just make changes daily. He would just come through a new function, and he just
Okay, here we go. So we have 2%. Risk-free rate is pretty damn low for these years. Makes sense, I think. 2018.
one day he was feeling
This is post-financial crisis. I don't think the treasury yields were that high, close to 0. So that kind of makes sense. Markets.
You're a big camel case guy.
Oh, and these are monthly too. So yeah, that's fair.
Snakes don't go away. But it takes more space. Snake is like long as fuck. Camel case is like immense.
yeah, 3-1. It's
Yeah.
not that much longer.
Listen, hear me out. I'm single letter.
How much of the average returns reflect the systemic risk of the strategy?
Yeah, exactly.
People are like, oh, what kind of so nice? And it's just like, okay, yeah, you write it, you know you can make your shit. If your language is a language where no one can read your shit, like you don't. Yeah.
Okay, so I think to answer this question of how much does the average return reflect the systemic risk of the strategy, how much of this return reflects performance beyond its benchmark predicted by the CAPM?
I mean, is this all recursive? Any like functional part? Well, that's a different issue. Functional programming is the goat. I'm not even gonna lie. That's what Turing envisioned. Yeah.
Right, so I'm thinking that, okay, let's just assume our beta is 1 here.
I know he was a big.
We could just take the average of all of the returns. So the average of all of these, the HML, small minus big, high minus low, small minus big, and then the average of the market risk premiums, and then we just subtract those two. So let's try that then.
No, it's true. That part's real. The rest I made up. That part's real. You gotta keep them on their toes.
Okay, so we can, let's see what we can do here. We could take our scaled data frame, and then we'll take the mean of this, right? Display.
I know it's like math. No, I know, but what is it? Just applied math and science of computers? Like, what is it? What is AMSC? I know that's all the courses that are like goated.
I don't know.
Socks, but
Yeah, just all the box. This is Google Maps. I mean, Google's so not you try, yes, organize it. Education, terms, each folder, each folder is organized. 5 is 1, 2, 3, 4, 5, so it's sorted too. And then they go like 466, 422, 72.
So an interesting thing here is that the market's risk premium is higher than the returns from the HML. So I think maybe this strategy might not be the best way to go about it. Also display, so let's try subtracting these columns. We have
the ones I've taken, the one I've taken, I should say, the single length class is not hard.
HML
He also like speaks German.
minus MKT RF.
So I'll place in the one that's like, I'll try to place in the one that's like maybe easier. It's like, I wanted to take, because I want to study ball and jump through. So I wanted to take a class and be like,
Oops. Okay.
I wouldn't be a student in the day. I think I'm not taking anything. It's like,
Alpha is equal
I don't know
to
if that's a really good issue.
FF scaled
and this is still my
display. Okay.
If not, then I'm going to do it. I need to know.
Or maybe we could take the average of alpha.
I was like, hey, what about that research? He's like, oh, yeah,
That'd be
I'm like, alright, I'm done. I just walked out.
Alright, so there's a negative alpha here.
Well behaved young man. He is a real treat, a delight.
Okay. Let's also create a graph real quick to kind of see what the relationship is between, because just looking at these numbers doesn't really tell me anything. Big X.
They cut down like emissions by 80%.
Why would he need to stop switching in? Well, yeah,
I don't think those are related, to be honest
Yeah,
with you. Someone still has to teach both classes.
Now he gets less work.
He probably just likes doing them back to back, so he doesn't have to like switch it.
Like, which is he switches out.
No, but like the course is just, it's still the same. Yeah, but like the content is the same. He doesn't have to like relearn C for like an extra 6 months to study.
But it's like for 20 years.
Yeah, I know. It's just insane. And it's like it makes us do these.
Okay, so this is just the monthly returns.
Imagine you get like, right?
Let's maybe take a look at if we can plot
What's that?
What if you just like don't do well on like
MKT,
How does
RF.
that help you?
It's fine. Fine, because I mean,
Oh,
it's
it's not.
it's totally possible.
What's like the point? Is that for you to have the answers?
Right, and then maybe it'll be easier for us to do cumulative returns too. Okay.
Oh, it's like find mistakes.
Okay.
Okay.
See, if all the TAs got one question wrong,
Right.
that's
Fifth.
not
Okay.
take that one off.
All the TAs got it right.
Okay, next. So like this
Fifth
semester, they're
TF scaled plus 1.
next semester they're starting at 2. And some of the sessions
Oh, they're all like afternoon.
afternoon, some go from 5 to 6. That's special. This is much. I've never done it.
And they're mandatory. Great for
That's I have a 5 to 6 class this semester. It's like a steak. It's like once a week. It's KM interviews. It's the stupidest type of pair paper. Nothing. We get out after about 20 minutes. It's so sick.
Where you think?
Wednesdays, 5 to 6. And it's just a pain because I just have to walk all the way. I spend more time walking back and forth than I do in the class. But it's
Okay,
like,
so this graph, the orange represents the cumulative returns of the market. This blue represents the cumulative returns of HMB, the HMB factor, HML factor. So as you can see, there's kind of not too much of a big difference, but I feel like comparing these two might not make the most sense in the aggregate, because this is return on the market. This is you're subtracting returns here.
there's like 4 assignments the whole semester, and you can just look up how to do them because it's all just different. Like,
You're subtracting returns from high book to market to low book to market. Okay. So I think maybe it would be better for us to log. So let me see. Log,
and whatever, then you're done. It took 5 minutes.
scale,
But it's like the whole class just goes over like 10 different ciphers every week.
lib.
It's like no one's paying attention. But it's so weird because everyone shows up. The class is full every week. There's no attendance, there's no anything. And I can't figure out for the life of me why everyone's there. I'm also
Okay.
showing up, but I show up to the class.
I think this is what we can do here.
I don't pay attention, but I do show up. So I can't tell if everyone other than me is really engaged with the content, and they're just showing up for that. I don't know what's going on. It's so bizarre. Unless there is attendance and I just haven't realized. But like, I don't think that's the case. I don't think so.
I think the mentioned that.
I hope there's no midterm because I haven't been paying shit attention. I don't know what the fuck's going on. Let me check it out. I got more.
So what I've seen, okay, I think according to this graph, as you have, so you have periods of really sharp declines in market returns, excess market returns. You have sharp increases, then you have sharp decline, and then you have a sharp decline in market returns, then you have a sharp increase in HML. So I think what this means is that during good times, the HML portfolio performs worse, versus in bad times, HML portfolio performs better. So the HML performs
He would have told us about it basically.
worse during good times, while
That would suck. Luckily, I don't think any of it's hard.
performs better in good times. I think this makes economic sense.
Cybersecurity famously really easy, super low barriers for entry.
Okay, so does that make kind of this economic sense? I think so, because
So you know what you're
was gonna say the few days, or like days.
I think that probably does make sense because as you have a lot of companies, a lot of growth in the market, then
Hopefully, so what's the features in the screen? It looks like I printed the and
What about the 322?
yeah, just the same way as the
then market values are kind of inflated and book to market ratios kind of decline.
It does all the ML. They're just all private. Good job, Quinn. I'm sure that's how you say it.
Okay, so economic sense. As market prices rise, the actual book to market ratio of a lot of companies decline. And for companies who don't have a high market price, then they're really not growing in this period of really good time. So mostly these small firms are growing and they're adding value to the market. So if you have a lot of growth in these smaller book to market ratio companies, then the returns of these smaller companies are probably going to be higher than the bigger companies. Okay, maybe there's no size. Instead of size, it should be ratios. So bigger ratios versus smaller ratios. Then when you have periods of bad times in the market, you have these valuations or these ratios and the growth firms that have declined. So the growth has slowed down, the market prices have declined. These are pushing the book to market ratios a little bit higher. But also, market prices themselves are being affected. Okay. Yes.
That's their posting. This is gonna get loaded. Yep. This is gonna stand for photo like 20 people in this classes. No. Oh, maybe like zero. This 30.
Okay.
Yeah, I don't know if they're gonna have English now. Maybe like 5 people. Yeah. Yeah.
During good times, prices of growth companies rise.
I think it was the same shit. So there will be like 100 people.
Low book to market ratios rise. Price of growth companies, low book to market. Ratios further down. Lower. times. So value companies generates higher returns. Okay. So how much of the average returns reflect the systemic risk of the strategy? How much of the Right, so can we run a regression with both? So what if we run a regression to try to predict the returns? Okay, so maybe we can run a multivariate regression too. Multivariate in the sense that we want to try to predict. Well, actually, what if we try to run a regression on HML and market RF? So we could use HML as our independent variable, the market risk premium as our dependent variable. And let's see what that gives us. So I think what we could do is we can import stats model as stats. So I forgot what stats model. Stats model. Stats model dot API as SM. Okay, so we could do sm dot OLS. So we have, say x is equal to y is equal to y x dot fits. Alright, and then results is equal to print results dot summary. Oops. Right. weights, and we do need. Okay, so I think we can add a constant somewhere. So let's equal sm that add constant x. So there's a negative alpha. So there's negative alpha, beta is pretty high. That means, But I feel like I'm not too sure if these are the right variables we should be using for the regression. I'm not entirely sure. I'm gonna think about it. I do have class soon, so I'm just gonna end the stream here. Yeah, I'll catch you guys.